I'm Charlotte McLeod with investingnews.com, and here today with me is Keith Weiner, founder and CEO of Monetary Metals. Thank you so much for being here. Great to have you as always.
Hey, Charlotte, how are you?
I'm doing well. How's 2026 going for you? It's our first time talking this year.
Crazy busy.
I believe it. I know you just released your 2026 gold and silver outlook report, so we've got that to get into today. But I thought before we jump into what's coming up, we could take a quick look back at 2025, just get your overall review of the year, maybe look back at your predictions for last year and how they ended up panning out.
So I predicted about a year ago that gold could see 3,700, I think the number was, and silver could see $37, both of which were kind of aggressive targets. And at the same time, I try to keep it real. I don't want to be, somebody promoting hype. So when the prices of both metals, and obviously especially silver, went way past those targets, I'll call that a victory because I got the direction and even approximate magnitude right. And then, silver in particular ran away. What's interesting, right? We always look at the basis, the gold basis and the silver basis, which is our measure of abundance or scarcity to the market. And we're interested in how does the basis move as the price moves. So at a very mechanical level, the basis is the spread. This is futures price, what people call paper gold, and this is the price of the metal, cash on the barrelhead, give me a bar. And there's a spread between the two, which is usually positive. That is, future is more expensive. And there's a lot of theory to be said, and I've written, I don't know, probably a million words over a decade or more writing about this. But at a very mechanical level, if you see prices going up, and these are so close together, if you were to plot spot price and future price on the same graph, it would look like one line. Like you need to zoom in like an electron microscope level of precision to really see that they're a bit different. But mechanically, if you see the price is going up, but the spread is widening, which means the futures price is going up more. So that means that's where the bidding pressure is. People are buying paper, and that's, because they can get 20 to 1 leverage. I mean, buying metal is, more expensive and more logistics, and you have storage and everything else, and you don't get leverage. That dealer will sell you that coin or that bar for cash. Whereas here, they'll sell you this thing for 5% down or 7% down, right? So if you see this is widening as the price is going up, that's where the bidding is, and the arbitrageurs are pulling up spot to stay close to futures, but with a little bit of a lag and a little bit of, I call it reluctance. So what the normal pattern, or at least the pattern, the whole market today is still trained. It's like Pavlov's dogs. Everybody's been trained by, the price action of, the second half of 2011 through into 2019. And that was every time the price would blip, all the gold and silver analysts would come out with their pictures of rocket ships and the moon and the stars and all these things. And that's it. This is the signal failure. It's really taking off now and all this. And, 100 times during that period, that was not true. And the price would blip, and anybody who bought the blip would regret it because the price came right back down and made a new lower low. It was a bear market for, into 2018, certainly. 2019, it wasn't, I guess, a bear market anymore, but hadn't really picked up that much yet. And, anybody who trusted the so-called breakout, and there are all kinds of technical indicators that said breakout at all these various times, anybody who bought that lost. And so, after, imagine if Pavlov kind of had, two ways of training the dogs. Sometimes, like if he wanted to reward them, he'd give them the food. If he wanted to punish them, he'd whack them across the nose with a newspaper. And, he rings the bell and the dog comes for the food, but he gets a whack. After 8 years of that, the dog's trained. Don't come for the bell. You're just going to get smacked in the nose. And so that was the normal pattern is you'd see a blip in the futures market and it was speculators betting with leverage. Now, what happened in 2025, which is very interesting. So price is going up. Okay, fine. And 99.999% of people are following price. and maybe, trends, which is, price momentum and that kind of thing. But it's all price, 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 price. But if you're looking at spread, you notice that in 2025, particularly in silver, but to some degree in gold, you see the price rising, and instead of this going up like this, it's this being pushed up, and the spread is compressing as price is going up. And that, if you want to see higher prices, that's the signal you want to see, because that means people are buying metal, which means unleveraged, right? So if you're buying futures with 20 to 1 leverage, that by its very nature is a short-term flip. First of all, it's extremely risky to be leveraged. And secondly, there's a lot of cost to it. And so, one way or the other, they're out of that position, either because the price went up and they took their profits, or the price went down and they hit their stop loss. Either way, they close the trade, and so what goes up comes right back down. But when people are buying metal, it's unleveraged. They're taking metal, which is much more expensive to get. The bid-offer spread is much wider. They're not doing that as a flip. They're taking metal and then maybe bringing it home and burying it under the floorboards, so to speak. And so it's a much more durable effect on the price. And so we saw that in spades in silver, to the point where now in October, the price of silver was going up, as I recall. And this spread actually inverted, and that's called backwardation. So the price of metal in the spot market was higher than, so imagine if this being pushed up, being pushed up, being pushed up to the point where it actually surpasses. And that's what had happened. So on October 20, if you sold physical metal and you bought a December futures contract to recover your position, you would pocket $2.15 per ounce in silver to do that trade, which is astonishing to say the least, and an indication of real scarcity. And so post that, the price of silver continued to go up and up and up. Silver is backwardated right now, or at least as of, I haven't looked today. I don't think I looked yesterday, but on Monday, as of Monday, it was backwardated, and it's been in and out of backwardation since October. So real scarcity, even though the price here, we are at 80 something dollars, that would have been hard, to really imagine a year ago or, 2 years ago when the silver price was in the 20s, to say, yeah, we're going to have $80 silver and backwardation at that price. Would have been like, nobody would have made that call. So that's what, you want the year in review. That's how I look at it.
Yeah, that's a great way to review 2025. And I wonder if you can talk a little bit more about this trend toward demand for the physical metal, because it's something I've been hearing a lot lately in terms of entities taking delivery of physical gold and silver. In your view, why is this happening? Why is it wanted? Who is wanting the physical metal? And do you see it continuing in 2026?
I guess one thing to clarify, I don't think that it's the same people who used to buy paper now want physical delivery. I think the people who are demanding physical delivery are different players than so the people that are buying paper, people who are buying futures, are less present. Now, in the run-up in January, the paper buyers and the leverage, particularly in silver, got to a pretty extreme level. And so that's why, here I am in Dubai. One person here was describing the price chart of silver like the Burj Khalifa. That's that crazy spire that's 154 stories tall. Now, a lot of people may not realize this. The base of the Burj Khalifa has these pretty big buttresses. It kind of makes sense. It's a very tall building. It's like 800 meters or something. So, it's a lot of wind force and whatever. So you want a really wide base so it doesn't, tip over in the wind, or I don't think earthquakes or whatever. But anyway, so the price of silver kind of looked like the Burj Khalifa. And as the Burj Khalifa goes up, it keeps actually stepping back. So it's not perfectly vertical, even all the way up almost to the very top. And so someone said, oh yeah, the price of the silver chart looks like the Burj Khalifa. It's like, yikes, that can't be good. And in the weeks leading up to that, my feeling was, I don't know when, but with a rise as vertical as this, and then when I'd run into, bullion traders at banks and things like that, oh yeah, we're telling our clients to position, get out of this because this is going to have to. So anyway, so leverage blew out. But, what's happened in silver, I think, right? So you have the solar play, silver is used for solar panels. A lot of these stories, become stale, and by the time they're circulating through the investor community, the story is either more than fully priced in, or maybe even not entirely true anymore. And so, what's going on when silver's $20, then manufacturers of things like solar panels just aren't that worried about it. But when silver like quadruples to $80, if there's one thing you can bet, it's that every whether it's the factory manager or the CFO or the CEO, is summoned in the team of engineers at every solar panel company, every antimicrobial countertop company, every like anti-odor gym sock company, because they all put a little silver in there, which kills the bacteria, and that's great. Or obviously in solar panels, washing machines, they have relays where they can turn on and off the various motors. Those relays have silver plated contacts. And the makers of all these things at $20, maybe fairly chill about how much silver is being used. But at $80 or $120, you can bet your bottom dollar. They're calling the engineers in, and they're like, please work on optimizing this product to use less silver. And so economists have a term for this. This is called thrifting. Reduce the thing. So as everyone thinks, oh yeah, industry is consuming all the silver, just as that story is really, bubbling to the surface, is when industry is actually working on, consuming a lot less, because there's a financial incentive, to do so. So, but what I think is happening is, the silver market is a much smaller market than gold. It doesn't take nearly as much buying pressure to drive the price up, and it doesn't take nearly as much selling pressure to drive the price down as it would in gold. And with the price of gold being where it is, remember, gold has outpaced wages everywhere. So whatever your wage could afford in terms of ounces of gold 2 years ago, you can't afford that number of ounces today as the same percentage of your weekly wage or your savings or whatever. And in India, that's doubly so. So India is a country, 1.4 billion people, and 100% of them are screaming mad for gold. You can't. I just had an interview earlier today with a reporter in India, and she was as astonished, I think, as your audience, presumably Canadians and U.S. people, would be when I said, look, in the West and in the U.S., less than 1% of investors would have any gold. I mean, her eyes widened. She was like, "Oh my God, really?" She just can't imagine that. And here, if I say, look, 100% of the Indians have gold, the audience here is going to be like, what? Really? Like that? How could that be? So 2 worlds apart, and it's not even remotely similar. So 1.4 billion people, average per capita GDP across India, $3,000 a year. So they're all screaming mad for gold, but most of them don't. I mean, there's an increasing, wealthy and affluent class that make a lot more money in almost, Western levels. But, most of them don't make anywhere near that money, but they all want to put as much as they possibly can into gold. So you'll get some untouchable caste guy, literally cleaning poop out of the streets for $2 a day, which is the minimum wage. And he will save up for months or years or whatever, and he'll buy some tiny little fleck of a grain of gold. And he'll be really, really proud of that. And he'll be working to get a second fleck to add to his, collection. So now price of gold's gone up a lot. The preferred, or I should say a preferred method of buying gold in India is jewelry. Now, Western analysts talk about jewelry demand versus, savings or money demand or whatever you want to call it. They're the same in India. The jewelry is sold by weight. So you're buying a necklace, and that necklace could be 5 grams. I picked up one in a jewelry store here in Dubai, 89 grams, almost 3 ounces. I pity anybody who has to wear it, because at the end of the day, you're going to have a welt on the back of your neck. I mean, it was really heavy. So it's sold by weight. And then there's a making charge, they call it, which is the fabrication cost, which is, Dubai, very often single-digit percentage points. So people are buying jewelry here at the same premiums that normally people would pay for a maple or an eagle. But that's how they buy gold. And there's usually a little screen in the store somewhere that shows what the current gold price is, and you're going to pay that plus whatever 5% for the making charge for the necklace. It is investment demand, pure and simple. Now, as the price goes up, people have to buy less gold. And so, first you make it hollow. So, it used to have these big, solid, chunky links in the necklace. Then you make them hollow. And then you make it thinner and thinner. And then you make it kind of a lacework thing where it's, hollow, not only hollow, but you can see light through it because they're removing all this gold here and there. At some point, you can't make it any lighter. And so what are they doing? A lot of them are switching to silver. So it takes a little bit of buying pressure off gold, and which doesn't necessarily affect the gold market all that much, but it adds a little bit of, or maybe not a little bit of buying pressure to silver, which affects the silver market quite a lot. And so you get Indians buying silver for jewelry, which isn't, now they love silver, but not as much as they love gold. And if they can get gold, they'll get the gold. If they can't get gold, because, it's 50 at that time, $5,500 an ounce, now $5,000 an ounce. If you can't get gold, then you get silver as the next best thing. And so I think that's a big part of, what happened.
So, in your view, with these dynamics going on, you mentioned we've got the industrial users of silver going toward thrifting. Meanwhile, gold is expensive. So, in the East, they're looking to buy more silver jewelry. Is silver going in a more monetary metal direction with all of this going on?
Yeah, absolutely. If you look at, as it so happens, I have a somewhat antique, I don't know if it's a coffee pot, I guess, but it's solid sterling. And there's a creamer and a sugar bowl and, little lids, and it's all sterling. And, if you call around, there's absolutely no bid on that stuff as tableware or even as antique, curios. The bid is melt. So that's the market saying we want it in monetary form. We want it in bullion, either coin, cast it into gold, silver eagles or maple leaves, silver maples, or bars. So the market is saying we don't want all this antiquities and numismatics and tableware, whether it be forks, knives, spoons, silver platters, teapots. We don't want that stuff. We just want bullion. And so if, most people believe in the quantity theory of money, so the scarcer something is, the higher its price should be. And so the silver community in particular spent 30 years trying to argue that there's dwindling quantities of silver around as an attempt to it's like goal-directed reasoning. It's not really the right way to think about any topic. If you find yourself having a conclusion in mind and you're trying to find logic to steer its way to your conclusion, you should stop and say, what am I doing here? But, the idea is, okay, there's a dwindling quantity of silver, and by the quantity theory of money, the silver price should be higher. But if the argument is that industry is consuming all the silver stocks, that argument is that silver is being demonetized. And if silver is being demonetized, it just becomes an expensive industrial ingredient, no different from platinum, palladium, rhodium, etc. Maybe a lower price, obviously, than platinum or palladium, but it's just an industrial ingredient. And maybe there was a certain amount of consumption of stocks during a period of time, and now what you're seeing is it being remonetized with a vengeance, and everything that isn't in monetary silver form being melted to you talk to dealers and they're talking about melting so-called junk silver. So these are the silver coins pre-1965, and for a long, long time, people would just buy bags of that stuff by face value. This is a $500 bag, $750, $1,000 bag, whatever of it. That's all being melted to be turned into silver bars again. And, again, the market wants it in pure bullion form, not any of the rest of this, stuff. So I'd say that the silver is being remonetized, or it's reasserting its monetary authority. One way or the other, which this is how it always was. I mean, throughout, thousands of years of human history, working people didn't really get their hands on gold. Maybe occasionally, or they'd see a glimpse of it or whatever, but, the old saying was, gold is the money of kings, silver is the money of merchants. Copper, brass, bronze was the wages of the peasantry, um, and that was always historically true. And so now suddenly gold at $5,000 once again is kind of out of reach. Now, if you're in the U.S. or Canada and you want to, you certainly can buy some ounces of gold, but that those few gold coins you get are not going to be nearly as satisfactory a handful as versus silver. If you put $1,000 into gold, it's a fifth of an ounce, less than that because there's a much bigger premium on that small. You want to buy $1,000 worth of silver at today's price, it's like 12. Silver equals that is a handful, has a lot of heft. It's emotionally satisfying, and the 1 ounce coin is the standard unit. If you want to buy a fifth of an ounce of gold, where you buy two 1/10 ounce eagles, not really a standard thing, and the premium you're going to spend is hundreds of dollars an ounce. It could be a 10%, 10 or 12% premium on it. It's just not a very efficient. If that's savings, it's not a very efficient way to do it.
Yeah, I definitely see what you're saying there. And talking a little bit more about the remonetization of silver, I think another point that's been getting a lot of attention is the premium in China for silver. So is that all part of the same story, or how are you seeing that fit in?
Yes, ultimately, I mean, the stuff is all global, one way or the other. And each participant in the market, whether they be in the Netherlands, whether they be in Vancouver, whether they be in Phoenix, whether they be in Dubai, has a piece of the picture. They have some information. It's like one puzzle piece, and the tapestry is much bigger, right? And it's all of a piece. And the piece is that the regime of irredeemable currency is failing. Now, some people think, okay, the dollar is going to fail first. That's definitely wrong. That's not an opinion. That is absolutely, the dollar will fail last, and all the other things are failing. But in the rest of the world, they certainly have a love-hate relationship with the dollar. On the one hand, they crave it because it is the currency of greatest utility by far, and everybody finances the major things in dollars. And so if you're loaded up to your eyeballs in dollar denominated debt, you need dollar denominated revenues, or else. So they crave it, they love it, they need it. And if you're in China, you certainly don't want Indian rupees or Russian rubles or any of these other things, Korean won, whatever. Those currencies are not useful outside their countries. It's dollars. On the other hand, they have reason to hate, if not necessarily America. Now the Chinese government, we'll see what direction it's going in. And I don't really want to get out of my swim lane and talk about that part of geopolitics, but clearly things are a bit chilly between President Xi and President Trump at the moment. But leaving that aside, there's increasing views globally to look for an alternative to the dollar. Even if it's just like every business beyond a certain size wants two vendors for each thing. You don't want to be captive to just one vendor, two suppliers or whatever. And so, what can we use just to reduce our risk that we're exposed to one thing? And what they all want is another paper currency that would work, but that's not what they're going to get. There is no other paper currency that comes remotely close. And I'm talking about, orders of magnitude difference between the dollar and the next biggest currency, which would be the euro. Orders of magnitude different. I mean, it's not even night and day. They're not even on the same planet. And so the one thing that would work, or that will work, is gold. And that's the one thing that ain't nobody want that. All the central bankers around the world, they all go to the same universities. It's Oxford and Cambridge and Harvard and and so on, Berkeley, University of Chicago, right? And they all get the same training, which is some blend of Keynesianism and monetarism and neoclassicism. It's all the same rubbish. And so, I've been using this quote from Winston Churchill. He gave this real backhanded compliment to the U.S. and he said, "God bless America, because after they've tried everything else, Americans will do the right thing." It's like, okay, yeah, thanks, Winston. I appreciate that. God bless the world. After they've tried everything else, they're gonna go to gold. And so you're starting to see gold in very, very early edges. I mean, there's not a lot of this going on at the moment, but I think the trend is inevitable. Using gold to settle, because if you're not going to use the dollar to settle trade, it's got to be gold. There's nothing else that's gonna work. So, that being said, that makes gold very interesting, for a number of reasons. Meanwhile, on Twitter or X, the Bitcoiners are like, gold isn't being used as a means of exchange. Gold isn't being used for anything. They resent that, we say that about Bitcoin. And I had a tour of a jewelry wholesaler here in Dubai, last fall. And, after well, I was a meeting really, but after the meeting, they gave me a little tour of their place. And, it's one room. It's like, oh yeah, this is where the retail jewelers, count the jewelry and weigh it and test it and whatever. And, this is where they pay us. Okay, great. And they had this giant bolt cutters leaning in the corner, this massive thing. And I mean, just like the business end of it was like this big. And this thing must have been 20 kilos. I picked it up. It was like, I could really feel the weight of this thing. It's like, you guys must have some serious high security locks that you must cut with this. Oh no, we use that to cut gold bars. I was like, what? Oh yeah, when the jewelers pay us for the jewelry, they pay in kilo bars. And, if they owe us 3.7 kilo bars, they take out 4 kilo bars and we cut 0.3 of a kilo bar off. And that we give it back to them as change. So I said, well, you've just made me wrong on something, because I've been writing for years that the problem with the bigger bars is, it's hard. You can't make change. I mean, gold is really soft. You could carve it with your pocket knife, but you destroy the bar, you destroy the integrity of it. Nobody's going to trust it anymore. And here these guys are like taking a big loppers and cutting the bar off, and which logically makes sense, right? But just to see it, and they're just so in the West, we just sit here and debate all these things like it's some abstract academic theory. And then you go to a place like this, and the Indians and Arabs and the Turks, they're just doing it. They're not talking about it. They're not writing about it. I mean, imagine like 10,000 years from now, assuming there's still human civilization, archaeologists will be unearthing like a McDonald's. And there's going to be like PhD dissertations written about what the meaning of the antechamber to the, like the front lobby where you order and you go up to the counter, what the meaning of this was and what religious rites occurred in this space, because they're not going to really understand it. And even if they had access to contemporary American, let's say nonfiction writing about the culture, anthropologists or whatever they're saying, no one really talks about like a drive-in or drive-through window at a McDonald's. Like that's not the subject of, nobody talks about it. It just is what it is, right? I mean, if you're in Canada, in the US, maybe it's more like Tim Hortons in Canada, but if you live here, you just take it for granted. You don't talk about it. And that's how it is. They're just using it as, for them, that's normal. And if their government were buying, oil or corn or soy, paying in gold, in India, they wouldn't bat an eye. In Turkey, they wouldn't bat an eye. In the Arab world, they probably wouldn't bat an eye. The Chinese and the Russians would understand it because, okay, you're avoiding the dollar. Yeah, it'd be a little bit unusual. It'd be innovation for them, but you're avoiding the dollar. Okay, they would nod. They would understand. And Americans would be like, wait, what? No, they can't be. Nobody would be using gold. Well, yeah, they are. They are.
Yeah, that's a great anecdote. Thank you for sharing that. And just to go back to the Outlook report for 2026, I noticed it says right on the cover, the era of monetary competition has begun. So it sounds like that's the direction that you're going in with what you've just been talking about. But anything further you would add there? Because I think that's an interesting statement.
So, there's two angles to look at this from. There's the within the paper world, who's winning and who's losing. And unfortunately, for a lot of people, dollar winning, a lot of marginal currencies losing. And I think the big, big story, I mean, some people are talking about, I'm not the one to originate the story by any means, but it's not a mainstream story yet, is how, US dollar stable coins like Tether give access, right? If you are the unhappy subject of some, marginal country with a horrible inflation problem, capital controls, you can't get dollars in, these places. That's what you would want. You don't want to see your savings go up in smoke, but they control you, and it's kind of a semi-authoritarian dictatorship, whatever. Now with Tether and other stable coins, you have access to dollars, and the people are going to choose dollars while the regimes gnash their teeth and pull their hair out. And so I think that there's going to be a massive increase in dollarization around the world because the people will vote with their own wallets. And so I think there'll be a massive influx into the dollar, and the other currencies will fall against the dollar, and some of them will fail entirely. Others will just go down even faster than they are. And Americans are like, yeah, we're America. It's just because we're bad. And it's like, no, there's a more nuanced story here than that. And as what did Gandalf say in Lord of the Rings? Things have been done that cannot be undone, and now something's in motion that cannot be stopped. And that's that dynamic. So within the paper world, the dollar's winning, and will continue to win. But the entire paper world is going to lose ground to gold, because the paper world is designed to screw the savers and screw the investors. And as long as they have it under control, that screwage, if I can coin that term, isn't that great in magnitude. The people will put up with it. But we're entering into a point now where more and more people don't want to put up with it, and then they turn to primarily gold, but to some degree silver, and so thus is gold in a bull market? Yes, but then I would turn around and say it's only because we're measuring in dollars. If you look at it objectively, the lighthouse isn't going up; it's the ship that's sinking. So we're on the dollar ship saying the lighthouse is going up. Is the lighthouse in a bull market? Well, yes, but to be technical about it, it's the ship that's in a bear market. And so, in January 28th, the dollar ship hit under 6 milligrams of gold. And, will it go lower than that? Yeah, it will. How much lower? For this year, get the report and see my, price call on that. We'll see how that turns out. But, yeah, we're continuing to be in that market environment.
Just a quick note on Tether. So they're a US dollar stablecoin issuer, but they've also become a huge gold buyer. So how are you seeing that play out? What do you make of that?
Very interesting, isn't it? That even the big crypto players have a need for gold. And, I don't want to do a victory dance and gloat and spike the football and all that too much. But I think the people in the crypto world, when they make big money, they don't want to put it in fiat, but they don't necessarily want to keep 100% of it all in crypto, because they all know that crypto can be very volatile, and the bear markets, even if things eventually cover, the bear markets can be wicked. So if you want to take some money out of crypto and you don't want to put it in dollars, where are you going to put it? And it's a heavy metal beginning in G and ending in D. And so yeah, they reportedly have, was it 80 tons or something? It's quite a lot of gold for a private, party to have. We'll see what they do with it.
Yeah, we'll have to see how that plays out. And so you mentioned you've got the gold and silver price calls for 2026 in the report. We'll have a link in the video description so everybody could take a look and read it. But would you mind sharing what you see, given everything that you are looking at coming in 2026? Where do you see the prices going?
With some jitter along the way. It's not a straight line. It's certainly not a vertical line like January and silver.
Yeah. So we're going up, and maybe you could just talk a little bit more about how we can see those price corrections even when we're in an uptrend, because this move downward that we saw toward the end of January into February. I know a lot of people saw it as a buying opportunity and they were quite pleased with that. But there's also a lot of discussion among people who wondered, is this the end for gold and silver? What's really happening? So how do you see that? How do you see those ups and downs progressing? Is that just something we have to be prepared for?
Yeah, I mean, if the price is going to move very far, there's going to be corrections along the way. Markets do not move in straight lines. And, there's a self-similarity, right? So if you look at the 5-second chart, or if you look at the 5-day chart, or you look at the 5-month, they all have sort of a degree of roughness to them, which means, zigs and zags. It's not all smooth curve in one direction. And, there's a million reasons for that. One is, I have a lot of beefs with macroeconomics, but one of which is, the attempt to use equations to describe essentially human behavior. And there's two problems with that. One is, people are not like particles of an ideal gas. People have pesky things like reason and free will and stuff. But the other is that there's an integer quantity of people doing an integer quantity or discrete quantity of transactions. So using differential equations just isn't even right to describe, what's going on. And so because things are discrete, because futures contracts have a finite expiration date. And so there's a discontinuity when, this is in the process of happening right now with the February gold contract. We've got another, 10, 15 days. I don't know when last delivery, day is for February. And then it goes off the board entirely. And, by now most people would be rolled over into April anyway. Everything's discrete, which means you have edges. And, if you study physics, if you study engineering, when you have edges, you get discontinuities, you get inflection points, you get things that are very funky and don't really nice math equations to describe them. And that's part of it. And part of it is if people see a chart of a price that only wants to move in one direction, it becomes perceived to be safe to go in with a lot of leverage. Right? So this thing is going, it's a guaranteed trade, can't possibly lose, right? I'm saying all these things, not just facetiously, but I guess that's the mentality that develops. So people come in with all this leverage. Now the problem is, leverage allows you to drive the price a lot further. If you're on 20 to 1 leverage, you can push the price 20 times harder than if you came in the cash market. And then if you have more and more people piling onto that trade, you'll push the price, even if the trend is supposed to be going like this, you push it more than that. And, then because of the nature of leverage, the moment you have a downtick, somebody hits a stop loss order, and that causes another downtick, and that triggers someone else's, and you get a cascade all the way down until you flush the leverage. And so that's just, how markets are structured. And, everybody's trading. Most people who are trading are using leverage because it enhances returns. Just better deal with that. And the stackers should, you can't get killed if you're stacking metal, right? I mean, you bought the metal, you paid $5,600 for gold, whatever. Okay, you're not happy that gold went to 4,600 or 4,800, whatever it was, but it's not going to take the food off your table. You put savings into it that you don't need right now. Okay, fine. Put that metal aside and look back. I bought a lot of my metal back in late 2008, early 2009. And initially, there were little dips and whatever that, damn it, I missed it. I wanted to buy $20 cheaper, whatever it was at the time. That price is looking very quaint today. It was between $900 and $1,000. That's what's going to happen, over time. I mean, we're in a dollar bear market for reasons. And so, but yeah, people better be prepared for the volatility because as things go off the rails, which is what's happening to the dollar, yeah, there's volatility. And there's days when people can't sell the dollar enough. And there's days when they're desperately, urgently trying to grab as many fistfuls of dollars as they can. And the dollar is extremely well bid. And you'll see that as the price of gold falling. So you're going to get it. You're going to get it both ways. But the trend is clear, and the drivers are clear.
Well, I think that's a great place to wrap up, unless you had anything else on your mind that you would want to leave investors with right now.
If you don't have any gold, you should buy some. And it's not a function of price. It's a function of just have a little bit, just because. Start to think about where this monetary system is going. If you're trading gold, be careful. And I always advise against, using too much leverage. There's a guy, he may be watching this, in which case, hey, I apologize, buddy. But there's a guy that I know that was trading silver and had quite a long position in silver futures. It got to the point where he told me he wasn't sleeping at night. And, he's pulling his hair out and just feeling horrible about it. And I think that's one of those things, like how big a position is too big? Well, if it's interfering with your ability to sleep, it's too big. Back off. Don't use so much leverage. Don't have such a big position. It's not worth it. This can be a brutal two-way market. Obviously, look at the monetary metals indicators. If you go to our site, the bottom, it's data science. I think it's the category. Click on that. You see all the charts. Follow the gold basis. You'll be better informed than 99.9% of the rest of the traders out there. And be careful. This is dangerous times in a dangerous market, and you do not want to get flushed out and lose your capital.
Great advice to end on. And of course, we'll have the links for you in the video description so people can check them out. And next time I'll bring you a quote from Lord of the Rings, because I just started listening to the audiobook. So I will have one for you next time. But thank you so much for coming on to talk.
Thanks. Look forward to it.
Of course. And once again, I'm Charlotte McLeod with investingnews.com. And this is Keith Weiner of Monetary Metals.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.